All right, let's jump right into this month's analysis from the Macro Butler. The headlines are telling us one thing about the economy, but if you look a little closer, the data is whispering something completely different. So let's dig in and find out what's really going on.
So, the big question we're all trying to answer is this. Is the U.S. economy actually as strong as it looks? The headlines might be shouting boom, but as we're about to see, there's a much more complicated story unfolding just beneath the surface.
Okay, so first up, let's talk about the story you probably saw splashed all over the news. On the surface, the headline economic numbers for February looked, well, pretty impressive.
I mean, the January jobs report came in really hot. If you just look over to the right of this chart, you can see that non-farm payrolls jumped by 130,000. That's a pretty solid number, right? It suggests the job market isn't just chugging along, but actually picking up speed. So yeah, the headlines looked fantastic. Payrolls up 130,000, which is the strongest gain we've seen in over a year. And the unemployment rate, it even ticked down a bit to 4.3%. All the signs are pointing to an economy that's firing on all cylinders again. Or are they?
Yeah, but here's where it gets interesting. You see, the real story isn't in that shiny new number. It's hidden in the revisions to the old data. And well, this is where that whole rosy picture really starts to unravel.
And wow, here's the number that changes everything. A jaw-dropping downward revision of nearly 900,000 jobs for 2025. Let me put that another way. Almost 1 million jobs we all thought were created last year, poof, they just never existed. This paints a way weaker picture of the labor market than that January headline led us to believe. And you know, this weakness in the job market, it isn't just some abstract number on a spreadsheet. It's starting to have a real, tangible impact on the American consumer. And that's where we start to see some serious cracks forming. So, remember that holiday shopping spree in November? Well, it looks like it led to what the Macro Butler is calling a holiday hangover. Because come December, retail sales just hit a brick wall. You can see right here, growth was basically flat. And get this, once you adjust for inflation, real spending actually went down. That is a classic sign that the consumer is getting squeezed. So that begs the question, right? If incomes are feeling the pinch, how are people still spending? Well, the answer is pretty simple and a little scary: debt. Just look at this chart. Total household debt has absolutely skyrocketed to a new record of $18.8 trillion. That's a staggering 4.6 trillion higher than it was before the pandemic. And, well, here's what happens next. It's the inevitable consequence of all that borrowing. When debt goes up, so does the number of people who can't keep up with their payments. This chart, it's pretty clear. We're seeing a sharp climb in delinquencies pretty much across the board. Credit cards, auto loans, you name it. They're all trending in the wrong direction.
But here's the thing. This isn't hitting everyone equally. It's what's called a K-shaped cycle. Some people are doing just fine, while others are really struggling. And we're seeing some serious pockets of stress. I mean, student loan delinquencies just had their biggest jump ever. And office real estate? Delinquencies there at an all-time high.
And this pressure isn't just hitting families at home. It's also building up on the corporate side, putting a real squeeze on their profits.
Okay, so to really get what's happening to companies, you got to look at two key things. First is the PPI, the Producer Price Index. Think of that as what companies pay for all their supplies and materials. Then you have the CPI, the Consumer Price Index, which is what they can charge you and me. The difference between the two? That's their profit margin. Okay, so check out this chart. The blue line is basically what companies can charge us. The line below it is what their costs are. And here's the kicker. That gap has now turned negative. In plain English, their costs are rising faster than they can raise prices. That is a classic profit margin squeeze, and that is almost always bad news for stock valuations. And as if that margin squeeze wasn't enough, you've got this AI arms race happening. The biggest tech companies are planning to spend nearly $5 trillion by 2030 just on AI infrastructure. That is a colossal amount of cash they're going to have to burn through, which will strain their finances even more and probably means taking on a whole lot of new debt. Okay, so let's recap. We've got stressed out consumers and corporations getting squeezed. Now let's turn to a really important indicator from the Macro Butler. Historically, this thing has been incredibly good at warning us when a major shift in the economy is about to happen.
What we're looking at is the S&P 500 to gold ratio. It's a really simple but powerful tool. It just compares the value of the stock market to the price of gold. You can kind of think of it like a barometer for big shifts in the economic climate. And right now, this barometer is flashing a major warning sign. For over a year, the ratio has been below its 7-year moving average, which is a really critical long-term trend line. Now, this signal doesn't go off very often, but history tells us that when it does, you need to pay very, very close attention.
I mean, just look at the history here. As the Macro Butler points out, every time the ratio has broken below its 7-year moving average, it has never been a good omen for financial markets. From the 70s oil crisis to the dot-com bust, every single time, it spelled trouble. So what this indicator is really telling us is that we're at a huge turning point. We've been in what you could call an inflationary boom, growth and inflation both rising. But this breakdown is the signal that we're probably heading into the next phase, an inflationary bust. That's a much tougher environment, and you might know it by its other name, stagflation.
So given that we might be heading into this new environment, how should you, as an investor, be thinking about your portfolio? Well, here is the Macro Butler's playbook for navigating what might be coming next.
Okay, the core idea here is all about building a resilient fortress portfolio that's focused on real stuff. That means first, what to avoid. Stay away from assets that get hammered in stagflation, like long-dated government bonds. Instead, the playbook says to focus on high-quality companies with very little debt and on hard assets, things like energy and especially physical gold and silver as your main hedge.
So this whole analysis from the Macro Butler really lays out a compelling case that a significant shift is happening right under our noses, and it really leaves you with one final and really crucial question you need to be asking yourself. And if you're trying to figure out how to answer that question for your own portfolio, you can go a lot deeper into this analysis and explore specific strategies by reaching out directly to the Macro Butler. They offer institutional research and advisory services.